How important is your credit score when it comes to securing a mortgage? Your credit score is extremely important because it affects the proposed monthly payment. And the monthly payment determines how much of a loan that a lender will loan to you. And you do want the lowest monthly payment possible, don't you? Hello again. This is Daryl Williams with Win-Win Realtors TV here in Southern California. Thanks for watching this video. In this video, I have tips for you on how to improve and maintain a positive credit score. In order to understand credit scores, it's important to understand who's scoring your credit. There are three major credit bureaus. There's Equifax, there's TransUnion, and Experian. Those are the three major credit bureaus. Your creditors, people that extend credit to you, report to those credit bureaus the history of your paying. In order to understand how to improve your credit score and the importance of your credit score, it's important to understand who's scoring your credit. In this country, there are three major credit reporting agencies. There is Experian, TransUnion, and Equifax. As a matter of fact, you could go to their individual website and learn a lot about your credit score and how to improve it. Different creditors report to different credit reporting agencies. That helps explain if you run what's called a consumer credit report, your score may be completely different than if you ran what we call a mortgage credit report. And that's the type of credit report you'll need to have run when you apply for a mortgage. As it relates to improving your credit, let's begin at the beginning. I believe that a lot of us sometimes have the wrong attitude about our credit. We don't get real serious or concerned about our credit until we are adults, and usually our first experience is with buying a car, and we learn about monthly payments and things of that nature and how your credit score directly affects that. So what we want to do is really have the right attitude or mindset about our credit. Your credit is extremely important moving forward in life and in everything that you do. So in this video, I have tips that will help you improve your credit or maintain it. So let's get started. Credit usage. You want to keep your limits, your extended limits, under 30%. To give you a quick example, if you are extended a maximum amount of credit of $1,000, you want to keep the amount that you charge on your card under $300 in that particular case. That will help you maintain and even improve your credit score. Credit usage. Length of credit history. There is a balance with the amount of credits and the length of time that you've had credit extended to you that is ideal for a lender. Typically, you want to keep the lines of credit somewhere between 4, in my opinion, no more than 6. And if you have lines of credit that have 24 months worth of credit payment history on them, those are considered good lines of credit. If you have a really good line of credit, let's say for 6 months, you've made all the payments on time, but you only have a 6-month history, it doesn't have the same impact as the lines of credit that are 24 months and older. So keep in mind when you are opening and or closing lines of credit, how it could affect your credit score. So length of credit history is another tip. Types of credit amount. Car loans, mortgages, credit cards. Those things, when paid on time, would have a very positive effect on your credit score. Types of credit amounts. New lines of credit. Now, I know that statement could sound a little contradictory because I talked earlier about striking that balance, and you need to consider striking that balance. Ideally 4, no more than 6. You could have 10 lines of credit, never been late, and you could have a lower FICO score than someone who has 4 lines of credit and have been late occasionally. So that's an important concept. I'm Daryl Williams. This is Win-Win Realtors TV. Thanks for watching, and I'll see you in the next video.